Okay, good. So, so this morning, what we're doing is, we have a special guest here, and, I just wanted to, I think I said this at the office meeting yesterday, but basically, RE/MAX agents are known to be the most productive agents of anybody out there, which is pretty awesome. We're also very career-minded. But that also gives us the respect that customers are going to look to us for information. They think that they rightly know that, we don't have to be the ones to know the information, but we certainly are the ones that are like the hub of, or the spoke, the hub of the wheel, where we know a CPA, we know an attorney, we know a title company, we know an inspection company, we know all those people, but we're the center of that. We're not any of those things, but we at least know how to get in touch with those people. And so, as I said before we started the recording, is basically we're not attorneys, so we can't give any legal opinion. However, when I go through a contract or whatever, I'll still paraphrase what they're looking at, and then encourage them to talk to an attorney if they feel more comfortable. That's fine. But when it comes to CPAs, I'm definitely not a CPA, and I definitely have a tax person that does my taxes. I'm not at all good at that, but at least I know the go-to people, where to go, which is what we're talking about. Friends of mine, mutual friends of mine, Bob and Wanda Hobgood down on Marco Island, used to live there for like 19 years, and they're friends of mine, and he was asking me to come do a little evaluation of his home, that he had talked to Esther, and that there was went through this whole process of something and said, wow, I've never heard of that thing before. Are you sure this is on the up and up? Because this doesn't sound right. Because I've lived here a long time. And this is about storms and having money come from the IRS. That just doesn't sound right. So so I went down there and talked to him. And the more he talked to me about the process, the more I thought, my gosh, this is a really important thing to get out to more people, our agents, so we can talk to our customers about some of the benefits that may be there. And when I found out that Esther was like on a little bit of a mini crusade herself, getting the information out, even though she's based in upstate New York, she has a place on Marco, so she knows, the laws affecting natural disasters and stuff, that word is not out. So even our local CPAs and people may not be aware of this because they're this is something unusual for all of us, but I really wanted to have her come here in person. This is a form, just so you know, it is a really legit thing. This is form 4684 and from the IRS. And so the IRS is here to help from the government, and they're to help. Anyway, that's a joke, but I really wanted to introduce Esther. We have her here. Gulyas is the name. Actually, it's
EG Tax, because nobody can say the name.
Right, I know.
So in Buffalo, before I changed it to EG Tax, they would call and say, "Is Esther Gulyas there? Is Ether there?" So I just said, we'll make it EG Tax, and it's easy.
Yeah. But she has 32 tax offices. Home base is up in upstate New York, but she has office on Airport Pulling in Naples. And she lives on Marco, and she also has office in Arizona.
Yeah.
I don't know how Arizona.
I don't either. Like nice places to visit.
Scottsdale or something like that. Yeah.
It is.
That's
good.
Yeah. And so she has radio shows, she does podcasts and stuff. And so I really think it's important to have it come directly from her, the information that have been conveyed to me from my friends on Marco. And I hope that you'll take this and give the information out to your customers. So Esther, could you?
All right. Thank you, guys. All right. Does everybody have my little packet here? Okay. So I believe in keeping it simple, stupid, because I could labor you down in all these laws and then you'd say, oh, forget it, but here's the concept. It's always been in tax law that if you suffered a casualty, that you could take it as an itemized deduction. Then when Trump got into the presidency, he said, nah, casualty losses are only if you're in a federally declared disaster area. Federally declared disaster area. And my whole thing is, Nobody knows. In upstate New York, because I'm the tax lady, I've been there forever and ever, and I'm very proactive about letting people know things that would affect them, you know? And so if I write a press release in Buffalo, people go, oh, wait, Esther's saying something. What's she talking? I did press releases down here. Nobody called. Nobody called. Now, here's the thing. I'm gonna give it to you in a thumbnail sketch, but this is kind of a real simple explanation. Here's some other things, and then there's the actual tax form. So this is like, see, like it says Internal Revenue Service. I'm not making it up. So if you're in a federally declared disaster area and you suffer a loss after taking all of the insurance and FEMA and all the other bennies that you get, whatever is still left, and it's the decrease in fair market value. So what people keep thinking is it's going to cost me $100,000 to fix this. That's not it. If the house, when it was standing, I'm going to use house for instance, if the house before the storm was worth $2 million, and after the storm it's worth $500,000 because all that's left is a foundation on a lot, you may never ever fix it, but you are suffering a $1.5 million casualty loss. And over and above that, your furniture and the cost of the demolition and the cars that don't work anymore and the boat that doesn't work anymore, all of the decrease in fair market value from what it was worth prior to the casualty and what it was worth after the casualty, limited by what you paid for the asset. Okay, so if you paid $2 million and it was worth $3 million, you're going to be limited to the $2 million. Okay. From that, they reduce it by 10% of your adjusted gross income plus $100. Why $100? I don't know. So if you have a house that was standing there that you paid $2 million for, that was worth $3 million, and it's worth just the lot, $500,000, you have a $1.5 million casualty. Now, what can you do with that? If you didn't itemize, it comes over and above your standard deduction, so you get the full 1.5 million as a write-off. Okay, and if you made more money in last year in 2021, then you can take this casualty loss and bring it back to 2021 to wipe out whatever income you had paid taxes on. All right, then the leftover gets carried over to 2022, and so on and so forth until it's used up. Now,
There's
is
no
it as
time
good?
limit?
Pardon me?
There's no time limit on that?
No,
And the loss
until you
carry
lose
forward?
it, until you use your loss. Now, where was it? So the thing is, it's not like FEMA or insurance where you're going to get dollar for dollar. It's all going to be multiplied by your tax bracket, which means that for those of you realtors, I'm assuming you had really good years. And if you suffered casualty losses and you amend your return, maybe you got $50,000 coming back from last year and maybe $50,000 from this year. And maybe when you carry it forward, you won't pay taxes, income taxes. You got to pay the FICA on the net profit, but you carry it forward and you may not have gotten the $1 million in insurance, but maybe you'll save $400,000 in taxes. And to me, money is money. And that's really about it. Really, I mean, there's business casualty losses. If you're in business, you get to take it as a direct write-off, or personal casualty losses. And pretty much it's the decrease in fair market value. So that's why Maury went to see my friends Bob and Wanda, because it was like, what was the house worth before the storm? What's it worth now? Because they have to put on a new roof. You really can't sell it unless you get a new roof, that kind of stuff. So it's the decrease in fair market value. So I gave you a kind of a little thumbnail sketch that the IRS put out. There's more explanation if you want to go to the IRS's website, but here's the actual casualty loss form. But the whole thing is, if nobody knows, nobody will ever ask for the money back. And the statute of limitations is 3 years. So like, the last hurricane, big one was what, 4 years ago. So people that are just finding out, like I've had people say, oh my God, Esther, but I didn't know that. After 3 years, you lose it. So if you don't use it, you lose it. And so knowledge is power. So what you don't know is unbelievable. So any questions? Anybody's thinking like, I mean, this is a great opportunity to tell people, wow, you may be able to get some substantial money back from the IRS, and they pay you back with interest.
How about a client that owns a resort on Sanibel that were the 1950s cottages that she bought in the 70s? So you're saying it is wiped out, like it's right on the beach, but
Well,
it's gone.
Cost or other basis. So she paid 200,000.
And it's worth
But
like
since
6
then,
million.
she's put in. It all depends if it was depreciated. If she's done things that weren't depreciated, then the basis goes up, but it's going to be cost or other basis.
Mm.
So if that,
So if we were to go back to Bob and Wanda, for
Yeah.
instance, what Bob was looking for is a valuation of the property prior to the storm.
right,
So is
and
that?
so it's
is
limited.
that-
So the
so
form, if you take a look at it, it says what you pay for it.
Mhm.
Well, when you put in your furniture and all this stuff, you might have paid
Mhm.
1.5 million. How much was it worth before the thing? 3 million. You're limited to 1.5. How much insurance you getting? None. So you have a $1.5 million potential casualty loss, but your land is still worth
Right.
$500,000.
Right.
And then from that, you reduce it by 10% of your adjusted gross income plus $100. Now, here's the thing. Let's say somebody's saying, yeah, but I got an IRA worth $1 million, but really I don't have much income. Utilizing this technique, if you had $1 million casualty, you could actually take your $1 million out of your IRA, which would then make you have $1 million in income, which would then reduce your casualty by 10% of that, or $100,000. So now your $1 million casualty is going to be limited to 900,000, and you're going to end up paying taxes on that 100, but you'd pay 40,000 versus 400,000. So it'd be a great way to take money out of your pension plan.
So what about a Roth plan?
Well, that's tax free anyway.
Yeah.
Yeah, I know, but
So-
at the same time.
No, it only works
Yeah.
good when you're offsetting taxable income.
What about an S corp?
S corp is good.
You could use it against that too?
Yeah, because the S corp comes forward to your personal
Right.
return. And this is, so if your personal return says $200,000 and you got $1 million casualty, that wipes out the 200,000, they give you back your money. Next year, you still got 800,000. They give you back that money. The next year, you still got 600,000, then that wipes out that income, and so on and so forth. So you end up with the net operating loss.
So is there any guidance on what fair market value before and after calculate, how that's determined?
Well, and that's where somebody would order an appraisal. I mean, like, for instance, it seems to me that, like on Sanibel, that you got real estate listings said it was $3 million, and hello, what, it's only worth the land right now. It's worth the land, plus you got to tear down the house. You know, so it should be, the important part is documentation. People that they're gonna know that they have casualty losses, and they would work with their accountant. If you, by the way, on here, this is my Buffalo business card, because that's where I'm, but if you take a look at that phone number there, that's my cell phone, and I'm down here all the time. And if you go to my website, there's a thing called Ask the Tax Lady. You can email me, you can call me. I'm not going to charge you, because to me, this is my way of helping people. Because I feel, I'm gonna cry. I feel terrible. I feel bad that my house and my car and my boat work. And I see these people there's right off of Marco, there's the Isles of Capri. I think it's like 4 feet under in elevation than Marco, and those people lost everything, just like on Sanibel. They just have their houses and their roof.
have a question for you.
Yeah.
Sort of applies to commercial, okay? My wife and I own the center where our businesses are housed. Concrete block construction, ground level. It has residential units above it. Long story short, we had 3 feet of water in it. That place is, that's all toast. That's been, you know, gutted, so to speak. Let's assume you paid $1 million for it, you know, 20 years ago.
Right,
And the tax records today show that it's worth 3 million.
Right.
Let's use your
Right.
example. Let's also, so in other words, the same principle applies.
right,
If you put on metal roofs, if you made improvements, obviously you're gonna be depreciating that.
right,
over
but
the
whatever
years.
is left, let's say
So
you
you
put
have
on
an adjusted basis in the property,
right.
right?
So let's say your metal roof that you put on 2 years ago was $500,000, all right? So now your million plus $500,000 is 1.5, but the depreciation you took was 50,000. So it'd be 1.45.
Sure. Well, I've got a great account. This is great, you know, really. I mean, it does apply to commercial properties.
Yeah.
And,
And again, it not only, you know, if you have questions on this or how to help people, or even with your own Schedule Cs, Deb, you know, you're the extension because of the hurricane is now February the 15th, and that extends your SEP contributions too. So, yeah,
For those that were displaced by the storm, is there any,
can you talk about,
oh, I'm sorry, for those that were displaced by the storm that took a replacement rental property?
that,
Is that?
that's would be business, just like his Sanibel place. So then when it's rental property,
No, I'm not saying
Residential
They were
rental.
living in their primary residence that was damaged. They moved into a rental.
Okay.
The cost of the rental.
you mean for you you're paying their rent?
No, like say I lost my home and I had to move into a residential rental because I can't live in my.
No,
home.
it's strictly the cost for the asset. Okay, and all the associated costs with the, like attorneys and, you know, all, but it's gotta be tied to the asset. And don't forget your cars, your couches, your dishes, your microwaves, the contents of the house, that all gets added in. That's why a lot of people say, well, I paid $1 million. Yeah, but you got $400,000 worth of outbuildings and things, you know, that all gets added to the basis. But then you can either amend your 2021 return, or you can just wait for 2022 and carry it forward. Obviously, you'd put it on the return that you made the most money for if you're gonna amend it. Any other questions? I mean, it really
Well,
is.
Sylvia, it is interesting, and I'm curious, you know, with Sylvia, having, I mentioned that she lives across the street and she had 3 condos, one she lived in, and 2 she had as rentals. And so, she's playing cards with her friends, neighbors, and the storm comes through and takes the roof right off the top. So, obviously that one is gotta have work, but then she decides to move into one of her other ones. And then the association decides to declare, or whatever. Just, condemn, well, the association is condemning, not a county or whatever. So now she's out and she ended up buying another unit and trading or whatever, but
Did you
so.
do a 1031?
I didn't do anything.
Okay.
I'm supposed to close tomorrow. Heavily discounted.
Wait a minute, so why don't you do a 1031? You could still do it before you close. You guys are aware what a 1031 is?
We did
Yes,
the first
but-
two.
Okay, I bought that condo for $87,000 a year ago. And I don't know, this lady was in a terrible situation, but it was worth 150 pre-hurricane, all right? This investor, through my community, I get people calling me to list property. And the ones that were heavily damaged, people came to me, Sylvia, what can I sell these for? Fire sale them. They're worth 200,000. I sold one for 55,000. I sold another one for 60 and another one for 80 that wasn't damaged. Mine.
Okay, well, now this is what you have. You have not only you can look at it as a casualty loss, or you have an involuntary conversion. In an involuntary conversion, you have 24 months to the gain's not gonna be taxable, as long as within 24 months you reinvest the money.
But I made a deal with this investor. I paid retail for his, okay? Seller financing, I didn't go to the bank or anything. Seller financing, my down payment was my condo. That's uninhabitable. There's nothing wrong with it. They just shut off the electricity and the water in the wing.
Right.
So I said, hey, this is a heck of a deal, because it was worth 150,000
right.
pre-hurricane. Would you take my condo so I can buy yours? And I paid retail for that one. My down payment on the other one was 85. So I really didn't lose much because I bought it for 87.
Right.
And, you know, I don't have capital gains on
Right,
it.
so you could do a 1031, you sold before the closing, if you could get an exchanger.
But
But
what does that do for him? I mean, the advantage.
well, he has a higher basis because he's selling it. He bought yours, but he sold yours, right? No, his basis is going to be,
It's an exchange. You have to understand.
all right,
You
so
can't
are you
really-
doing a 1031?
No,
or
I'm not. What I wanted to do was heavily discount my property that's not damaged for him to take it, so he can pay the association dues
Right,
every month.
right.
We've got.
And
two
then he's giving you
assessments coming.
his,
Yes,
and there's no money exchange? Just the mortgage?
correct. That's on the difference of 215 versus.
Okay, so
85.
you're gonna end up with a higher basis.
Correct.
Yeah.
Yes.
And then his is gonna be the fair market value.
Well, you can't live in it.
But
for
I
2
mean,
years,
he's
so-
150,000, because that's what he's giving you, so that'll be his basis.
Yeah, but you can't live in the property.
But eventually he will,
In 2
he's gonna wait
years.
it out,
Yeah, yeah. So.
because he knows it'll be worth that much more.
Correct, or maybe more.
Yeah, right, probably.
Mhm.
So, and the other thing is with real estate, you know, it's highly favored from a tax perspective, you know, you guys are self-employed, but from a tax perspective, you have, if you live in a personal residence 2 out of 5 years, then the gain up to $500,000 on a joint return is tax-free. I'm assuming you guys know that. 250,000 if you're single. And so let's say that you had somebody that bought a house a year ago and then they said, I don't want to be here anymore. I'm going back up north. Even though they didn't fulfill the whole 2 years, there's special exception. If you didn't live out the whole 2 months, 24 months, if you move because of cause, and they'll still allow you to take part of that exclusion. So that's in there as well. So, anyway.
That's a lot, yeah. Yeah. Any other questions?
I have a question. So because I'm not familiar with the IRA, Midland IRA, we have Midland IRA, I have stuff in. Do you recommend that for her, compared to what she's doing with the 1031?
Well, I mean, a 1031 is a tax deferred exchange, and they call it tax-free, but it's really tax deferred, because basically you're taking the basis of this property and moving it to this property, and so you don't pay taxes on this sale, because because all this money is moving over to this thing, and so it saves you a lot of money.
Right.
You know,
now she'll be
But
saved.
not only do you have the casualty losses here, you also have the involuntary conversions. In other words, I didn't want to sell it. Got knocked down, right? And so you have 24 months to reinvest without having to pay taxes on it as well.
So you have a like-kind exchange.
That's on a 1031.
Mhm.
So there's involuntary conversions in 1031. But obviously, if you have somebody that wants to buy it, like somebody wants to buy it right now, and you have to then find another like-kind property. It could be land, could be commercial, but as long as it's real estate for real estate, then you can defer the gain from this place to this place without having to pay taxes until you sell it.
Sure.
But if you get real lucky, you die. Because, now think about this, if you die, when it's gonna happen to all of us, your estate gets it at a stepped up basis, so your heirs don't pay any taxes at all. So that's another thing with real estate. Real estate is so cool.
I don't want to.
I've got it.
Go ahead.
The values, I lose my house. It was not listed for sale. My neighbor just sold their house for $1 million. I think my house is nicer, it's really worth $1.2 million. I can't go back and get an appraisal for
But,
September
but you
15th.
ought to be able to
Sure you can.
establish, there's something
Yeah.
called the Cohen ruling, where if you can reasonably establish a basis, and obviously that listing and the sale would just exactly what the mortgage people do. They do comps, right?
Right,
And
Yeah,
that's what I did for Hubble.
Right.
So he said, okay, September 28th was a storm, so I did my search of sold or
Right.
whatever up to that date. Because that's the historic information. I use that as the basis.
So that would,
see
but
that.
if you didn't pay that much, you're still gonna be limited to your cost.
okay, so to my current value, the lot that's $500,000. Do I need a formal appraisal on that? Do need
I
to-
would get as much concretes, the going in one, you can't do much about
Right,
because who
right,
knew, right?
Right.
But this one now, I would pay that, and that appraisal fee increases your loss, your
Right.
casualty loss.
Okay, thanks.
Similar to the same kind of appraisal that happens when somebody dies. Intestate without a will, okay, don't they go back and do a forensic appraisal, for lack of a better term?
Yeah.
And they determine what the value of the property was,
On the date of death,
there you go.
and then you get a stepped up basis and you don't pay. I mean, that's my game plan. I'm gonna die out of this mess. True, it's the truth.
How about the
But now I
client,
got an estate problem, so, yeah.
how about the client that had her house up for sale? It was going up for sale on Friday and the storm hit on Wednesday.
And so,
I suppose she probably already had her pricing.
well, so whatever she paid for the house, right? Versus what it was worth at the time just before, where you had it listed, whichever's lower is gonna be her basis. And then from that, she takes 10% of her adjusted gross income plus $100. But to that, she adds all those other things that she isn't getting reimbursed for, the couches, the chairs, the pictures, and all that kind of stuff. And the removal and the legal fees and,
We are a trust company, so our clients are clients of our trust company, so. We're helping them through a lot of these, navigating and referring them to certain professionals and whatnot during all this. We just hired a CPA as head of our operations, and she had to go to another meeting at 10, but if you're here, I would love to
well,
grab her
she
before you
certainly
go.
knows this stuff.
You think?
Oh.
So
What I
that's
don't
what-
understand is
that's
how
what
nobody's
Maury-
talking about this.
Well, that's what Maury's like, CPAs don't seem to know this, so I
Oh my
haven't been
God,
able
yeah.
to talk, I didn't know what it was.
They have
So
to,
now that I know what it is, so she probably knows about.
oh,
it.
she better know, or you got the wrong.
All right. She said she brought over a lot of stuff. She goes, find out what you can, because I didn't know
Okay,
what it was
well,
about. So, okay, so she knows. all
Yeah,
this stuff.
but if she
Okay.
can call me, I'd be very happy to help.
Thank you.
The bottom line is, I really want to help these poor people. So,
And the stories, well, you all are Sanibel people, right? I mean,
Just three of us.
okay.
and in your own
Yes.
situation, I mean,
Oh, really?
Right.
So,
you think,
It is.
oh,
It's so
gee,
horrible.
my roof just blew off, but otherwise I'm good. But how much did your house devalue then? And so maybe your casualty loss is only $100,000. Okay, so then you only saved 20,000, but I'd take 20, right?
Well, I think Jeannie left, I know, but Jeannie had her house. Let's see what,
And cars.
yeah, but before this was something else that happened. That was like it was an isolated tornado down there with, she has a single family home, but there was a trailer park or whatever, and it really got decimated, but her home also got affected seriously. She'd just gotten that back together, and then this hit. And then she had storm surge in her house too. So, I know she had to leave a little early, but.
But I mean, you have to really sit around and reevaluate what you really had in there.
Mhm.
And you think, oh my gosh, that picture, you paid $1,000 for the picture, wow, my couch, all my dishes, everything, all my clothes.
Yeah.
Shoes, I mean, it all adds up. And so you may not get it in the, maybe because of appreciation, you may not have that increase, that big decrease in compared to what you paid for the house in fair market value. Although some people that had no flood insurance and the homeowners is not gonna do it, On top of that, though, you put all of your other personal things and your car stuff, it all adds up. So, all right.
Thank
All
you.
right. Esther, thank you very
Anything
much.
you need, don't forget, my website, my website is egtax.com. This is my phone number on the bottom, 716-472.
Can you read?
7444.
Can you read that slower so we know?
Oh, it's egtax.com.
Now, what was the phone number again?
And in Buffalo, my phone number, my corporate headquarters is 632-7886, area code 716. My phone here, because it's with me all the time, 716-472-7444. And by the way, if you ever have a tax question, you can go to my website at egtax.com. And there's a place on there, Ask the Tax Lady. That's what I'm called in Buffalo. And I'll answer you back right away. And there's no charge. And I just want to help.
Esther, thank you very much.
Anything with real estate. I've had about 100 houses in my life.